Hello and welcome to our weekly look ahead at the markets. And well, to recap, last week we saw a decent run up in the FTSE, the UK blue chip index, up roughly 3% for the week, finally cracking that post-pandemic high and recovering to levels not seen since February 2020, before the big sell-off really unfolded. The FTSE 250 also made an all-time high as positive vibes around the UK reopening story supported the more domestically focused stocks. Oil prices were lower, the market still digesting the implications of the OPEC Plus decision to increase production from May through to July by roughly 2 million barrels per day. That has capped oil price enthusiasm, but nonetheless we still think that there's probably a lot of destocking going on and demand will start to pick up. Oil inventories, of course, will be out as usual this week. Keep your eyes open for those ones. We'll have our usual coverage. And also this week we have the start of earnings season in the US. The big Wall Street banks coming up as is custom to start things off. We have JP Morgan. Jamie Dimon, the CEO there, last week published his annual letter to shareholders, in which he suggested that the economic boom that the US that is unfolding in the US as we speak, really, that could last through till 2023. He thinks that whilst by almost all measures of valuation, stocks look expensive, he says that with the economic fundamentals looking so positive, that alone could support equity valuations as they are. So he's very positive. We'll get another update from him in the quarterly report, Q1 numbers. We've also got reports from Citigroup, Wells Fargo, Goldman Sachs, Morgan Stanley. Any update on the Archegos fallout, of course, will be interesting to watch out for. None of those banks really suffered any hit, not like Nomura or Credit Suisse. Goldman was the one that pulled the plug on it in the first place. So it'll be interesting to see exactly what sort of trading revenues we've seen this quarter from some of these big Wall Street banks. The SPAC boom, mergers and acquisitions and so on, have been very good, so that should support trading revenues. We also think probably the provisions for loan losses could continue to fall as the effect of stimulus checks and ongoing support for businesses plays out. So big banks kick off reporting season next week in the US. And then otherwise, we're looking at data, inflation data on Tuesday for the US, CPI numbers. Now, last month was up 0.4%, but that was the last sort of easy month, if you like, ahead of what's expected to see some big year-on-year prints, simply because of base effects from last year when we saw prices decline because of the pandemic, and also because we've had all this stimulus coming through and people are starting to release that pent-up demand. So be careful with these inflation numbers. It could be easy to read too much into them, but we need to see what the Fed makes of them. At the moment, given the Fed minutes that we saw last week and given what Jay Powell's been saying, the Fed seems happy to look through any big increases in inflation over the coming months. And then finally, it's the Reserve Bank of New Zealand. It's expected to leave its cash rate on hold at 0.25%. So that's it for the week ahead. We'll be back as ever here on X-Ray.